Welcome to the Introduction to Managerial Finance video tutorials. In this section, we are going to go through an overview of two debt ratios. These ratios assist us to analyze the debt position of a company. This indicates the amount of other people's money used in attempting to generate profits. In general, we are most concerned with long-term debt because this commits the company to paying interest and eventually the principal amount over a long run. The other concept to consider when looking at debt is financial leverage. This is the magnification of risk and return through the use of debt. The first ratio we will look at is the debt ratio. It measures the proportion of total assets financed by the firm's debt. It is calculated by taking total liabilities, in our example, 1.9 non-current liabilities plus 1.2 current liabilities, and dividing them by the total assets of 9.1 million. We get a debt ratio of 34%. This indicates that 34% of our assets are financed by debt. The greater this ratio, the greater the degree of indebtedness, and the more financial leverage the company has. The second ratio we will look at is the debt-equity ratio. It is a measure of a company's financial leverage calculated by dividing its total liabilities by shareholders' equity. It indicates the relationship between how we are financing with debt versus equity. Some analysts prefer to use only long-term debt instead of total liabilities, as current liabilities would generally fluctuate greatly through the year. In our example, we have 1.9 million non-current liabilities. I only used long-term debt for this calculation, divided by 6 million in shareholders' equity. This gives us a debt-equity ratio of 31.7%. This means in comparison to equity, we have 31.7 long-term debt. The bigger this ratio is, the higher the degree of indebtedness and also that of financial leverage.